Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
Since these slides were made, and we've had the Fed commenting about inflation misbehaving, which is exactly the pattern that we've been noting over recent weeks. I'd say the economic vibes are mixed. We've had some absolutely staggering corporate earnings, particularly from the tech sector, but continue to hear about on the street, the main street suffering when it comes to the economy. When we speak about the change of the guard, we'll ask whether expectations have actually changed with that in terms of the trajectory of interest rates. We will digest some of the earnings that have come out of equity markets and always speak about portfolio implications for that. So when it comes to inflation, I think it's important to think back also about the expectations for inflation, not simply about the numbers as we are reading them. We've commented before that the numbers that come off are typically somewhat distorted. They are backward looking. They may be incorrect in some cases and need revision. And certainly they will perhaps show where the lead, the dominant influence of those numbers comes from. And we also know that food and oil have been distorting some of the headline number over time, and that we need to sometimes strip that out. But when it comes to expectations, it's interesting how expectations can be self-fulfilling. And to take Japan as an example, it is important to remember that Japan has struggled under a deflationary environment for many decades. And this was a struggle in their case to simply generate any inflation. Deflation was destroying asset values and generally not stimulating much economic activity, very low interest rates in response to that. And here we can see that in Japan, their core CPI is back below 2%, unlike prices in other developed markets, with Japan there being the blue line on the top left. And what we can see is that even despite the fact that there have been consumption tax hikes in Japan twice over the past 25 years, that only causes an initial spike, and then inflation tends to settle back to its trend line, and it's still below 2%. So definitely quite a distinctive muted nature of inflation in Japan, again, because expectations are perhaps not around price rises, whereas expectations of high inflation can drive spending habits, which can in the short term drive prices even higher. The second chart shows that when we look at the spoils of war and how Iran has transformed expectations of the ECB, what we can see in this is, again, if we were to compare the Bank of Japan with the ECB implicit rate for the end of this year, we can see that the Iran war has had a direct effect on what the ECB is now expecting, whereas inflation was hovering below 2% in the Eurozone at the time of the breakout of the war in Iran. We can see that it is now getting closer to 2.5% and even going close to 2.75 by the end of the year. So it was notable that the ECB had already halted its interest rate cuts, but the one thing that was preserving the Eurozone from a stagflationary outcome was the fact that inflation was exceptionally low, and that was also taking some of the pressure off the European consumer. If the European inflation starts to tick upwards, some of it driven by energy prices, particularly as we move into winter, that is likely to continue to place stress on the European consumer. If we look at the components of inflation, we are seeing Brent not only hit a high today, we're seeing over $130 a barrel, but also as we look to the December forecast, it looks like this price will be sustained. I've seen the taco being replaced by nacho, which is the sense that not a chance the Straits of Hormuz will open. So if there is not a chance they will open in the near term, and we know that the geopolitics continues to percolate around that this would certainly be negative for oil prices in the sense that it would drive them higher, negative for the consumer of the oil prices, that is. And we've also heard not only about the impact on oil, but also other commodities. Agricultural prices now are at a 30-month high, according to the Bloomberg Agricultural Commodities Index, and that will all filter in to higher sticker prices, not only of fuel, but also of food. Moving to the Fed, we discussed last week the change that was coming there in terms of the confirmation hearings of Kevin Warsh. And we know that there is an increased focus on the balance sheet here as the war rolls on. We now are hearing that the Iran war has cost 25 billion, according to the Pentagon official. So clearly, the use of missiles and defense interceptors here have increased, and this is placing increased pressure on the federal purse. The comment around Powell's latest press release is that he is really staying the course in terms of maintaining a careful communication, but he is also, they've decided to hold the rate steady. I did make the comment about the inflation being unmanageable or misbehaving, but now we can see that rate change expectations have been moving. There's now an expectation that there may actually be hikes instead of cuts when it comes to the future output.